Okay, and now I want to give you an overview and introduction into financial reporting, and I want to start with the legal requirements for financial reporting and accounting in general. To have a look on the background of accounting in general, financial accounting and controlling. And then afterwards, I want to point out some main principles of financial reporting according to the international accounting standards. And I want to also talk about the parts of which financial statement or consolidated financial statement exists. And then in the end, I want to give you some ideas about financial key performance indicators which are used by the companies. So we start with the legal requirements, especially in the European Union, where the International Financial Reporting Standards, IFRS, have to be adopted by not all companies, but by companies which are listed on a capital market. We're going to talk about that later on. So financial reporting is part of accounting. So we have accounting as a function in companies, and where we differentiate between financial reporting or external accounting and controlling or internal accounting, information which is disclosed to the public on the one hand side. So this is financial reporting, information which is disclosed. And we have then information, internal information on the other hand, as part of the controlling function of the company. So the financial reporting we are talking about is addressed to external users. It's not only financial reporting according to the International Financial Reporting Standards. It consists also of other legal requirements, additional legal requirements like corporate governance standards or national GAAP, generally accepted accounting principles the companies have to adopt. Sometimes in combination, they have to adopt the International Financial Reporting Standards and national GAAP. Depends on the country we are talking about. And then we have on the other side the internal accounting, the information systems which are used for internal users, especially for the management board or for the supervisory board in the company. And the key performance indicators we find in financial reporting are often also used for internal goals, that the remuneration of the management board, for example, is based on KPIs which are derived from financial reporting. So these parts are connected to each other. We use it for cost and performance accounting, these KPIs, and also we use the information based on financial reporting for investment and financing decisions. So we have a strong relationship between this part of controlling or internal accounting functions and external accounting, especially financial reporting. So the KPIs we want to identify in financial reporting are also used for these internal goals, but also, of course, for external users who want to, for example, invest in the company. So what are the objectives and the information interests of the users based on the information which are provided via accounting systems? You want to provide useful information here on the left-hand side for decisions, for example, for investors, if they want to buy or sell shares of the company, and they base their decision on the information which are disclosed in financial reporting, for example, the profits and losses which were generated by the company in the past, These information are used for acquisitions. If a company wants to buy another company, which should become part of their group, then we need this information about this company we want to acquire. Financial institutions inform themselves, especially on financial reporting information, but as we also have learned in the past, also based on non-financial key performance indicators, which have to be used in addition to financial information to rate credits, to make a credit rating. We use it for forecasts and to get information about the reliability and relevance of financial data in the company. And then we use this information as a calculation basis and for contracts, for example, to make payment based on the profits or losses which are calculated via financial reporting. I mentioned already the remuneration of the management board or the amount of dividends we can pay to the shareholder. And it's also a tax base. The tax base is derived from the financial reporting. So we know all these objectives of financial reporting, and these objectives of financial reporting are derived from the aim to reduce the information asymmetry that normally exists between preparers and users of financial statements, because the preparers have more information, internal information, as their external users, and the external users should be informed about the situation of the company with the help of the information in the reports, financial reporting. What are the users of financial statements? It might be also shareholders and stakeholders. We have talked about stakeholders. You have talked about stakeholders before. Stakeholders of the company you have worked with, that are internal stakeholders and external stakeholders, that are debt investors or equity investors, and the shareholders itself then as equity investors, or the financial institutions as debt investors, employees of the companies, the customers of the products or services of the companies, the suppliers of the company in the value chain. These are also users of the information which are disclosed in the financial reports. And then we differentiate between financial statements of an entity and the consolidated financial statements of groups which are formed of more than one company. So the financial statement of an entity is used to calculate the profits which can be shared shared with the shareholders, and it's also it forms also the basis for taxation. So we derive the tax base from the profit and losses which are disclosed in the financial reporting. So all these payments are derived from the financial statements of entities. The consolidated financial statements are only used as informational basis for the share and stakeholders. So we don't derive any payments from the consolidated financial statements of groups. It's just to provide information. So we have to differentiate between these financial statements from an entity itself and from the group of entities in the form of consolidated financial statements. And we have different legal requirements regarding to financial statements and consolidated financial statements. The financial statements are also published, and they also are used as an informational basis, but not only as this informational basis. They are also a base for tax payments or for payments to shareholders. And that's not the case for consolidated financial statements. where we combine the financial situation of all the companies which form this group. And you have worked in the past with these consolidated financial statements, which were published by the groups, and have talked about these non-financial indicators from the group. And now we want to have a look at the financial indicators from these groups. If we have a look in the European Union, when we are forced, or companies which are located in the European Union are forced to use the international accounting standards, international financial reporting standards, if we are listed on a capital market. So the regulation of the European Union from the year 2002 forces companies to disclose a consolidated financial statement for the group according to the international financial reporting standard. It's a legal requirement in the European Union that the IFRS international standards have to be adopted. In most cases, in addition to local GAAP, to local accounting principles, like the HGB, Handelsgesetzbuch for Germany, or the UBG, Unternehmensgesetzbuch for Austria, all the other local gaps we can find in the European Union for the entities itself and not for the groups. Yeah. So we have to differentiate between international financial reporting standards and local GAAP. And regarding to local GAAP, when we have to build on the national legal requirements in addition to the legal requirements which are based on European law. But next to this, I want to mention that the international financial reporting standards have to be adopted in a lot of more companies worldwide next to the member states of the European Union. So what's the regulation in the European Union about? The objective of the regulation is to adopt and to apply international accounting standards in the European Union, that we harmonize the financial information, that we achieve a high degree of transparency and comparability of financial statements, because all the companies which are listed on a capital market in the European Union use the same accounting principles, the IFRS, and so we have statements which are comparable to each other. They are used for the internal management of companies and also to ensure the efficient functioning of capital markets in the European Union, that the legal requirements for listed companies are the same in all member states of the European Union. So according to the IRS regulation, the companies who are listed in the capital market have to disclose their consolidated financial statement according to the IFRS, the International Financial Reporting Standards. It's mandatory in all the member states of the European Union. And then the member states have the possibility that consolidated financial statements for companies which are not listed on a capital market can disclose their statement according to the IFRS instead of according to local GAAP. That's not the case for Germany, but the countries can choose if they want to have that as possibility for the companies to use IFRS instead of local GAAP. And that's the same for the financial statements for entities. So for individual financial statements, we have the possibility that IFRS could be used instead of the national GAAP from the perspective of the European Union, not from the perspective of the International Accounting Standards Regulation. And the member states have to decide if they want to allow that for the companies which are located in their member state. So for Germany, for example, it's not possible to have an IFRS statement for individual financial statements instead of a statement which is based on local GAAP. They can do it if they want to, but they have to disclose their statements according to the local GAAP next to that. So they are forced to use local GAAP for individual financial statements and to use IFRS for consolidated financial statements if they are listed companies. So I have to deal with both standards, with IFRS and with national GAAP. That's not the case for small and medium-sized entities which are not listed on the capital market. They only use national GAAP. They don't use the IFRS. So this is for big companies, for groups, these accounting systems. And we have a growing adoption of IFRS worldwide. So we do not only use that in the European Union. It's, for example, also very often used in African countries. In the US, we have the US GAAP as local GAAP as the dominant standard. So, but we use IFRS in a lot of countries worldwide. So, where do the IFRS come from? Yeah? Who is responsible for developing the international financial reporting standards if it's not a country or the system of a country? So it's an independent foundation. It's the International Financial Reporting Standards Foundation, which is responsible for developing the IFRS. And these IFRS are endorsed in the different countries worldwide. So we don't develop the standards in the European Union. We use them in the European Union after an endorsement process I'm going to talk about after these slides. So just to get an overview about the structure of the foundation, we have the important International Accounting Standards Board, IASB, and we have the Interpretations Committee, which publishes recommendations for the adoption of the IFRS. So the standard setting process is in the responsibility of the IASB and the Interpretations Committee, and they develop the standards, and then we have a process to prove this developing process with, for example, here the foundation trustees, which, for example, oversee the standard setting process, and the IASB has to inform the foundation trustees. So, significant characteristics of the due process of the IFRS are the active involvement of interested persons, organizations, and users into the process of developing such IFRS. So the IASB develops a draft for a new standard or for a revision of an existing standard, and then the users and other organizations like NGOs have the possibility to give their feedback on these drafts. And then through this involvement process, they can work on these drafts before they publish a final standard. So they should make the process more transparent. And that takes this due process, as you can read here, around 2 or 3 years and longer. So it's an intensive process of involving all the stakeholders in this process, because it's an independent organization which develops these standards, which should be adopted worldwide, so that we can harmonize the reporting over the world, so that we have a comparability. And for investors, for example, in the US, which are also familiar with the IFRS, then investors in the European Union and the companies as well deal with the same standards. No, we have the US GAAP, of course, but we have also this very prominent international financial reporting standards, and we have also an harmonization process between the US GAAP and the IFRS based on the convergence project. So the regulations of the IASB consist of a framework, an IFRS framework, and the standards, the IFRS itself. So the framework forms as a basis for the development of IFRS by the EASB. It consists, for example, of accounting principles which should be used. It's a basis for deriving accounting methods, for example. And when we have international financial reporting standards with more detailed content of how these financial statements have to be prepared and which accounting methods have to be used for specific assets or liabilities, for example. And when we have an implementation guidance, which also has a recommendation character, but what is not mandatory to adopt. If we have now these IFRS, which are developed by an independent organization, then we want to use it in the European Union. We have to use it because of the IAS regulation. And there we differentiate between an enforcement process and an endorsement process. The endorsement process comes first. That says that the IFRS that were developed by this independent organization have to be adopted in the European Union. And before this is the case, they prove the standards, and afterwards they have to be adopted by the companies. And the enforcement is the control process which follows after adopting the IFRS by the companies, and they control if the standards were used by the companies. So it's and controlling instrument for the financial statements itself. So the endorsement process comes first. We have the standards which were issued by the IASB, the standards board. And when we have advices from different expert groups for the endorsement, now if the standards should be endorsed as they were published by the standards board. So we have, for example, here the technical expert group, which is mentioned on the slide, or the European Financial Reporting Advisory Group, EFRAG, which works together with the European Commission or for the European Commission. So they have a process then in issuing the IFRS from the EASB, and then before it becomes mandatory for the companies in the European Union, the Commission has to adopt this IFRS, and this is the endorsement process. And after adopting it by the European Commission, by the European Union, it is published, and then it's mandatory for the companies. So we have a process between the publishing from the IRSB and from the from the publishing of the European Union. So that's the legal background, legal requirements of the IFRS. And now the IFRS have a list, a set of components which a financial statement consists of. So, and according to International Accounting Standard 1, IAS 1, a complete set of financial statement consists of these 5 elements you can see here. So we have a set of standards, and the standards contain then different, deal with different issues of financial reporting. And the first standard deals with the components of a financial statement, and also IAS 7 that talks about the statement of cash flows is related to this set of financial statement. And a financial statement consists of a statement of financial position, a balance sheet, a statement of performance, profit and loss, and other comprehensive income, a statement of change in equity, a statement of cash flows, and then the notes to the financial statements. And I want to go through all these parts of a financial statement, and we start with the statement of financial position, the balance sheet, where we have the assets and the liabilities. We have no specific presentation format. which is mandatory, which has to be used. That's different to most of the local gaps we know, where we have a specific structure that has to be followed. We have no fixed structure regime, but we have minimum line items which have to be disclosed. And we are forced to separate between current and non-current asset and liabilities. Deferred taxes are not differentiated between current and non-current assets to which they belong. They are defined as non-current assets and disclosed there in this area. So the minimum line items exist of different assets, here starting from the property, plant, and equipment until the assets held for sale. And on the other hand side, we have the equities and liabilities, the issued capital until the trade and other payables. These are the minimum line items of a balance sheet. And then we have the structure. For example, here in a consolidated statement of financial positions, we first have the assets, and this is followed by equity and liabilities. So we have one part of the balance sheet, which consists of the assets, and it starts here with the non-current assets and the current assets, but that's not mandatory. It could be right the other way around. It could start with the current assets and the non-current assets could follow at the end of the list of assets. So here in this example, you can see the intangible assets, property, plant, and equipments, non-current financial assets, and until inventories, trade receivables, contract assets, until cash and cash equivalents. So it depends on the currency. It's a non-current asset or it's a current asset. So we don't have a mixture of assets. It's differentiated in areas which are more or less tradable, easily tradable. And on the other hand side, we have equities and liabilities. And here it's the same case. We have a structure which follows the terms in which the company holds the assets, all the equities and liabilities. And then we have a first equity, which is based on a long term. And when we have short-term basis liabilities at the end of the balance sheet. So we start with the equity and then non-current liabilities and current liabilities. That's the first part, the balance sheet. Then the second part is the profit and loss statement or statement of performance, which consists of the profits and loss and other comprehensive income, so-called OCI. The comprehensive income consists then of net profit or loss and OCI, other comprehensive income. And we have the possibility to choose if we want to present it in a single statement of profit or loss and other comprehensive income, or if we want to make a separate statement of profit and loss and a statement of OCI. So these are two possibilities to disclose the statement of income. What's specific? Why should we disclose separated from the profit or losses, a part of this statement, which is other comprehensive income, OCI. And that includes all items recognized directly in equity and not through profit and losses. So these are differences in, for example, the valuation of assets that should not influence the profits or losses. They change directly the equity without changing profit and losses before. So if we have a different valuation of properties, for example, because the value of the property increases, then this valuation does not reside in a profit, it results in an increasing equity. So we have a different presentation of other comprehensive income and of profit and losses. So, and here you have a list what's all included in the OCI. for example, differences from currency translation, changes in valuation of available for sale financial assets, re-evaluation of property, plant, and equipment. That was the example I mentioned before. Gains and losses on pension obligations and such OCI, which results from associated companies and joint ventures, which are part of the group which discloses this consolidated financial statement. As for the balance sheet, for the statement of profit and loss and OCI, it's also the case that we have no specific presentation format, no fixed classification scheme, but minimum line items which have to be used. And as far as if this is relevant, we have to present additional items, headings, and subtotals to give a true and fair view of the profit and losses. Minimum line items are the revenues, gains and losses from derecognition of financial assets measured at amortized cost, financial costs, and all the other points that are mentioned here on this slide. I think I don't have to go through each of these examples. And then there are other items which have to be disclosed separately, only if they are material. So this definition of materiality is known for us from the sustainability reporting, where we have to decide which fact is material, which data point is material. Also here we have this in profit and loss statement. We have to disclose something separately if it is material. So we have to decide if it's important for the users of the statements to know exactly about this part of the profit and losses. So these are, for example, specific write-downs of inventories, for example. And when we have the possibility to choose between the cost of sale method or the total cost method, if we disclose, when we disclose the operating income as part of the profit and loss statement, then we have to disclose separately the results from the financials and the, for example, the interests we receive or have to pay, and when we have to disclose separately the income taxes. And the OCI, as you also can see here on the slide, is disclosed, the last item, separately. And again, an example from a consolidated statement of profit and losses, and we start then with the revenues. We have the different categories of expenses, also disclosed separately to each others, in this profit and loss statement. And then we have some subheadings titled with, for example, key performance indicators. These subheadings could be used as control parameters for the company for internal objectives. Here you can see the earnings before interest and taxes, EBIT, as one of these indicators to measure the performance of the company. Now, the revenue, and when we have some important expenses, and afterwards we receive the earnings before interest as taxes as one performance indicator which the company could use. We have also another performance indicator here is the earnings before taxes, EBT, mentioned as subheading, and then finally the consolidated net income, and then the earnings per share, which are distributed to the shareholder of the company. So these are the important information for external shareholder to know, for example, the earnings per share. And then they have the information about the earnings management of the company, the performance of the company, which could be derived from the profit and loss statement. So the amount of expenses related to the revenues the company generates. And separated from the profit and loss statement, we have the consolidated statement of comprehensive income, where we can see differences, for example, in valuation in the balance sheet, which results in changes in income, but not influences the amount of the profits or losses. The first part of the financial statement is the statement of changes in equity. This statement of change in equity is a statement of financial position of equal rank, and is not a note to the financial statements. It resides from, for example, transactions with owners or the total comprehensive income of the company. That's what we mentioned before, or effects of change in accounting principles. So we can see here in the increase or decrease in equity itself. So it's more information when is part of the balance sheet, where we also disclose the amount of equity. And then you can see here also as additional information what has to be presented separately in any case in the statement of change in equity, for example, regard to the comprehensive income. So the statement of change in equity, sorry for that. So the statement of change in equity shows the differentiates or the results of the profit or loss statements, the OCI. Also, method change and error corrections have to be disclosed in the change in equity statement, and the transactions with owners in their role as owners also have to be disclosed here separately in the statement of change in equity. And we can see it also in this example for the parent company, in our case of the consolidated statement of change in equity. And then we can see how the equity decreases, for example, because of dividend payments, or then, for example, of measurement of defined benefit plans are also be shown here in the statement of change in equity. Next part is the statement of cash flows. So in the statement of cash flows, we have a broad breakdown of cash flows for the period. Cash and cash equivalents are part of the cash flow. So cash at banks, cash equivalents are part of the cash flow statement. So we don't have here an accounting on an accrual basis, but on a cash flow basis. So we have to prepare the statement for 3 different categories: for operating activities, investing activities, and for financing activities. We have to make a statement of cash flows for these 3 different categories and calculate that separately from each other. And we have 2 different methods to calculate it. We have a direct method and we have an indirect method to calculate that. And for the cash flow from operating activities, we have the possibility to choose between these 2 methods, whereas for the cash flow from financing and investing activities, we have to use the direct method. That means that we have to calculate the cash flows directly from the activities that affect, for financial activities, the scope and composition of equity and liabilities. So this direct method is mandatory. We have to use it mandatory to show the cash flow which results, for example, from lending activities or from some transactions with owners, for example. And then we have the cash flow resulting from operating activities. We can then choose between the direct or the indirect methods. So we can calculate it based on the profit and loss statement and correct it because some of the expenditures, for example, which are disclosed in the profit and loss statement, are not related to cash payments. Sorry. Or we can directly calculate it, the cash flow which resides from operating activities, for example, the revenues which were gained based on cash payments. So here you can see again the direct method and the indirect method and how it is calculated. So the indirect methods, we start from the profit before interest and income taxes, and then we decrease and increase this amount, for example, the changes in inventories or trade payables. And then we have the direct method, and then the sum up all the cash payments, for example, which were made. Last, we have the notes as part of the financial statement. The notes have to present information about the basis of preparation of the financial statement. So they have to disclose if the statement was prepared according to the IFRS or local GAAP. And it has to provide additional information that is not presented elsewhere, for example, in the balance sheet or in the profit and loss statement, but that is relevant to understand these statements. So information that could not be placed in the balance sheet, for example, about the conditions, payment conditions for liabilities, is on a short-term basis or on a long-term basis, so that information could be given in the notes.